Today's topic is about tax deduction for small business owners, the common one, the one you really want to know. Let's start with what we set out to do, which is to talk about the most common small business tax deductions. So you may say that, what do you mean by small business tax deduction? There's a big business tax deduction I don't do? Of course, of course. So when you are small, and when I say small, I am talking about all of my clients are small. And so now you say, okay, so what kind of client do you have? So we have clients revenue size from 1 million all the way to 200 million annually. Trust me, they're small because by definition of IRS, they're small. So with that said, we're all small businesses. When you're small, there's some large tools. You absolutely don't need it. You absolutely don't need to know, and it doesn't apply to you. But what we're talking about today is everything that's going to apply to you on the daily basis. So before you set out to do the taxes on your own, I want you to listen to this webinar and be in sync with what's going on right now for 2022. I know it is confusing because sometimes when you talk about, oh, what is a deduction? What's new this year? Are you talking about 2023 or you're talking about 2022? And for the farmers, especially Iowa farmers, 2023 is a big deal. And if you haven't heard your CPA talked about a big deal in 2023, your CPA is outdated already because their new law come out helps farmer to save taxes in Iowa for 2023. But now what are we dealing with? We're dealing with what? 2022. We're filing 2022 tax returns. So tax people are historians. They are historians. They are not good at futuristic thinking. And our firm, and we combine the quality of financial people, financial planner, with the tax preparer, tax person. So with that combination, we see the near future. Actually, even financial planner, they don't see just necessarily near future. They see long term, right? They tell you that if you put away $3,000 a year, you'll be making $2.3 million when you retire, right? They talk like that. And no, in tax world, our longest future is the duration of the president. If our president's term is up in next 2 years, trust me, you only want to plan taxes for the next 2 years. There is no need to go further beyond the current president. Every president come to the White House, and it is almost like changing their bed sheet. They're going to change taxes. That's just part of life. So we all know that. And our goal is to understand if they're coming from Republican Party or they're coming from Democratic Party, and what kind of tendency the Congress is going to come through. So that's probably the only thing you can predict. And even that is just wild card. You know what's going on at the White House right now. So it's really unpredictable and pretty much like earthquake. And you just wait it to happen. And maybe some projection come out, maybe not. So with that said, tax people are historians by large proportion, and the good tax preparers would look at the future with the present duration. And with that said, we give you these tax deduction today is only focused on 2022. And you can see why I say that, because there's no need to go to 2023. You're not filing taxes right now for that. You only want to know what's going on for this tax filing year. You are in 2023, you're filing 2022. What can I deduct? That's the question you have for me. So no responsibility disclaimer, and loud and clear. You really should not rely on internet sources, do serious stuff. If you're going to go to tax court to debate your cases, and you are clipping out a internet sources or maybe my PowerPoint, go to the tax court and not going to give you any credit. What's going to give you credit is when you retain professional, have them express their opinion officially on paper, and or you retain that on the email because you are working, you're paying them for the service. That is one that has a weight. So just make sure internet give you some expansion of thought, good guidance, but just doesn't really, it's not effective in the court, in tax court. General information on business deduction. So very generally, and sometimes you may say that, oh, what kind of things can I deduct? That is a billion-dollar question, not a million-dollar question, because it's so general. Every business is different, right? But the IRS guidance are interesting. IRS do not have a black and white answer for you. What IRS has is, it says, okay, business expense are the cost of carrying on a trade or business. Listen to it. As long as you are in business, you have a business expense. That's what they're saying. So these expenses are usually deductible if business operates to make money. What they're saying is, it's not a hobby. You are really starting that up to make money. I just want to ask you, who doesn't want to make money when they run a business? Oh, there's a people don't want to make money. Remember those nonprofit? So someone say, Ying, I know that the nonprofit, they don't want to make money, and they want to lose money, and they just want to help the public. And that is not even right. The nonprofit means none of the profit need to pay federal income taxes. It doesn't mean you don't make any profit when you are in the nonprofit business. So business in general are coming through as an entity or as a purpose to make money. As long as you have that as your bottom line, and you're not a hobby, right? You're not a hobby. Even if you're collecting coins and you make that a business, that's not your hobby. If it is a hobby, you cannot deduct any expenses. If it is a business, you want to make money by trading those coins, and then you have a business, right? To be deductible, a business expense, IRS said, must be both ordinary and necessary. Ordinary and necessary. If it is ordinary but not necessary, no, you cannot deduct it. And just look at the slides. It has the two words with the and, not a or, right? You see a lot of documents at IRS, it would say or. If they say or means you satisfy one, you don't have to worry about the other one. But if it is and, that means both of them are going to be there. So necessary means more than desirable, but less than indispensable or absolutely necessity. So you don't have to say it is necessary because it's absolutely necessary, absolutely a necessity you have. So it is just more than desirable. Okay, ordinary means reasonable expenditures in support of the operation, reasonable expenses. So has a lot of subjective room for everyone. Am I right? So my recommendation is that if you are running a business, say you're running a restaurant business, and you should look at your business and look at how other people were claiming and make sure that you are falling into the norm of restaurant. But suddenly you have expense for tuition reimbursement. That I would not say is reasonable. That I may not think is necessary, right? So you got to look at your business nature to decide what is normal for you. And it is important to separate business expense from three things. From cost of goods sold. So if you say you have a utility bill, is your utility bill cost of goods sold? No, that was supporting your restaurant operation. Your cost of goods sold should be what? Should just be the materials, just be the labor cost affiliated with the materials like shipping and the handling, those kind of things, right? Capital expense, they're not a business expense straightforward. Capital expense means something you spend a lot of money and that thing can be used for more than 1 year, 2 years, 3 years. Just like you build a building, that building can last for what, 100, 200 years. So that's not a business expense in one shot. Capital expenses means that you need to consider rules and regulations to figure out how much you can bring into your expense, not all of it. Then personal expense, should that even be in your business? No. If you have a business, defined business, your personal expense should not be in the business expense. So that you all know. So the way we laid it out, the three expenses you want to make a point, make a note in your mind: cost of goods sold, capital expenses, personal expense. Cost of goods sold, 100% can go into deduction, but they're not the business expense we're talking about. They are part of the sales. Right after the sales, you deduct cost of goods sold, and then you have gross profit. Then you deduct all the indirect expenses, right? So cost of goods sold, 100%. Then your capital expenses depend. Then your personal expenses is what? No, not allowed. Not in the business. Okay, now, so when? That's another question we often see. So generally speaking, at what time am I able to deduct that expense? For cash method accounting, it's very simple. Whenever it came out of your bank account, cash method people, and you can actually look at your bank account, knows what's income, what's expense. Because if it is arrives to your bank as a deposit, that's your income. If it is coming out of your bank as a check written off, cashed by your vendors, that is your expense, right? But for accrual, it's a little bit different. Accrual means that if you sure that income is going to come, you send the invoice out to Community CPA, and the Community CPA never owe anybody bills. So we for sure will pay you. And in your book, if you are accrual, even though I haven't really sent the payment to you yet, you can count that as an income because you know it is coming. You know I'm not bouncing checks, right? So that is accrual on the income side. But what about expense? So let's say on December 31st, 2022, and you wrote a $10,000 check to buy materials because you are a Christmas gift shop and you pay vendors, but they give you 15 days to pay. So you bought the things already, selling it, but your bill is not going to be coming out of your bank until 15 days later on January the 15th. So do you include that in your expense or you do not? If you are accrual method accounting, and you would include that in your expense because and you know that is coming because that liability is sure liability. Okay, and you already have economic performance on it, you're already selling it. So that's why I wrote here, you can deduct once all events have occurred, that liability become real. I mean, liability become real means that your bank didn't pay it yet, but your check is gone. You cannot call the post office, goes, oh, I want that check back. No, right? And unless you place a stop payment, if you do that, you don't count that as expense because you placed the stop payment. You were not going to assume that liability, right? And it can be determined with a reasonable accuracy. Your liability is pretty sure. Yeah, I know that Community CPA gonna pay me for the full amount. You're pretty sure. You're pretty no, you pay Community CPA in this case, not income. You pay Community CPA bill, and you know that Community CPA gonna take your check and cash it out. So your liability is surely there, right? So With that said, economic performance has occurred just means that the stuff you're paying for is already working for you. Of course, Community CPA already performed the service, so it is already incurred. So you're already needing to pay, and your liability is sure. So you can include that as your expense because you are accrual method. Even though your bank did not, you didn't really cut, the bank didn't go off that amount yet. All right. So that is the general information related to the expenses. So let's talk about a couple more here. I'm going to cover automobile, business meals, and office deductions, depreciation, and a bad debt. Those are all very interesting ones, and I want you to stay with me and let's go through each one of them. Okay, for automobile deduction, that happens so often. Who who is the business owner, got into the business, can say that, oh, I don't need my car? Absolutely not. My business, I don't need a car. I I don't think I met any one of them like that. So everybody need a car. But when you have a car on your own, whether you're in business or not, we call that car is your personal car because it's titled on your personal name, it's insured under your family umbrella, and you have your auto insurance, you pay out of your pocket. So those are called personal car, personal vehicles. And when you have a business, you use your personal vehicles to conduct your business. So only for the business purpose. So we are asking you, is your personal car only used for business? That's the first box. You say yes or no. If you say yes, my personal car, that particular one is used for business 100% because I have another car and I don't use this one. This one is a car that is more presentable to my client. I use that just for business. Okay, my personal car, man, it makes sounds when I drive, so I don't drive that one to clients. But if I go groceries and stuff like that, I use my personal purposes. I use my personal car. So if you answer yes, let me tell you, you should make that personal car company car. 100% for business. If it is 100% for business, obviously, and you will list that on your company's balance sheet. What I mean by saying you will list the car on the company asset because that is the company car. Then you can deduct what? Insurance. No more mileage, folks. No more mileage. Insurance, gas, repair, and what else? Car wash, whatever you do for the car, it is eligible for you to treat that as expense for business. And of course, I will give you an audit tip here. When you get audited, you say, well, that car is 100% for business. That's not a very good sounded proof for auditor to feel that you're entitled for all the deduction. So the best defense, the best practice is you go to add a company's name on your title work. So that way your car has a title that is under you and also under the company. Because you're the only one driving, because you are a small business, so you're really small and you don't have employee and nobody drives your car, so just you, then you can buy insurance just still the way you bought before. So it's not increasing your insurance, but your car become a company asset. Now, and to become a company asset, one more thing I want you to know, and you can sell your cars to the company. The company owes you the amount to pay you back for the car because now car is company asset, right? Don't try to confuse yourself with the company. One, I always encourage our small business owner that as soon as you see the company is starting up, okay, you are going, make sure you separate these two. You want to be really clear between you yourself and the company itself. So give the title to the company so the company can take care of the car for you and pay you back what it owes you. Okay. Of course, if your answer is no, so is your personal car only for business purposes? You say no. I just have one car. I use it when I need it to run for business, but that's not 100% company car for business use. Okay, good. If you said no, you have two ways of handling the expense. Okay, one is called actual expenses. The other one is called standard mileage rate. So let's go for the next slide. So we're talking about the two methods. I bought this little chart over here on the right so you can see. So let's talk about these two methods. We go for standard mileage rate first. Remember, we're talking about 2022, ladies and gentlemen, and we're not talking about 2023. We're not referring to 2021. We're doing taxes for 2022. The mileage is from January to June, the end of June, is 58.5 cents per mile. But after that, till the end of the year, you go for 62.5. So what does that mean? That means your mileage log, you need to be split up between January to June and July to December. And keep in mind, your medical also got increased, but the charitable stays the same. So with that said, I have the chart here. It's straight cut and paste from irs.gov. It's no secret. And be sure, when you calculate the mileage, if you answer no, you're going to do standard mileage, then you are going to use this rate, right? Let me give you the 5 key components you must have to do the mileage. You know what? I'll save the 5 later. Actual vehicle expenses, that is, you need to retain receipts and all the relevant documentation related to the cost of driving as it pertains to business usage. So now, because you said no, right? It's not 100% for business. So you can get all the mileage, you can get all the gasoline, insurance, repairs, and the car wash, or whatever expense you have on the car, you put it together. And then you're gonna calculate still the percentage of business use. You may say that, how am I going to do that? Percentage of business use, that is determined by mileage again. So you would say that, oh, I drove 10,000 miles this year, but 10,000 miles total year, but 1,000 is for business mileage. So then your ratio is 10. Then all your expenses add together times 10. That would be your actual expenses for your car. Okay, so if you use standard mileage rate, you cannot deduct any expenses related to the car. And you may say that, well, then what's the difference between the actual expenses under the no answer versus the actual expenses under the yes answer? There is one big difference between these two, because under the yes answer, you actually can bring the car into the business, have a depreciation going on there. But under the no answer, you can't tap into depreciation. You cannot write off your car because it is your personal car. Make sense, right? All right, let's take a look at the last slides related to vehicle. And this is where we talk about the rate. I already summarized it for you. And I just want to point that, if you want to use standard mileage rate, you must choose to use it in the first year of the car is available for business. So let's say you bought your personal car in 2022 and you decided to use standard mileage in 2022, then you cannot be like in 2023 and calculated the actual goes, it is better off to do actual. You cannot do that. Once you have a method for that car, you need to stay in the same method. Unless you get rid of the car, change to another car, you cannot switch the method with the same car, right? And cannot use for 5 or more cars at the same time. So you may say that, whoa, I have 10 cars. You know, I like cars. I have 10 personal cars. And each one of these cars have like a little bit of a business miles. So I'm going to claim all of them. No, stop right there. You cannot have more than 5, right? So confusing. Don't even do that. We had one audit not too long ago. Maybe it was last year or the year before. So the auditor, you know, the taxpayers just have 2 cars. The reason they had 2 cars is because one car they used it for a portion of the year and then was broken down, was repairing, so they got another car coming in. I will tell you that this auditor was literally comparing day by day of how these 2 cars were driving on the mileage log. So the auditors are pretty thorough and they're trained to pick the needle out of the sea. Okay, that's a Chinese expression. I don't know that's a Chinglish, but finding a needle in the sea is probably not easy, but they're trained. They're trained to estimate, to figure out where that needle is at on the is where that is in the seabed. So they are trained that way. They will do that kind of job. So make sure that you don't cause unnecessary trouble for yourself. And if using a car you lease, you must use the method for the entire lease period. So basically what it says that you may lease the car for a year, then you just use the same method for that year. You lease the car for 3 years, you use the same method for 3 years. So it's limited to the lease terms, right? All right. And you must choose by filing date, cannot revoke the choice. So there's restrictions to that. Now let's talk about business meals. Okay. And this is an interesting topic. And I have clients very confused with the business meals because someone was telling him that, oh, 50%. Then someone also tell him that no, 100%. And then he came over to our firm and we didn't even mention anything for 2022. So his question is like, am I 50%, 100%? So we assumed people know that for 2021 and 2022, the business meal has this special ruling, the special incentives from IRS where we can take advantage of, but some people thought it is a rule that lasted forever. So no, it is only for 2022. We're talking about filing tax for 2022. Okay, so 2023 is different, but let's focus on 2022. And the business meal should still have a business purpose and involve dining with current or prospective customer, clients, suppliers, employees, partners, professional advisors, that including me. So if you take me out for meals, do you know that you can deduct it all? You know, maybe that's why I don't get a lot of invitations because you didn't know you can deduct 100% of it. But too bad, right? We're already in 2023 and you owe me from 2021 and 2022. So the food and beverage should not be lavish, okay? And should be reasonable. So what is the definition of lavish? And I think that depends on your life personally. So some people, if you talk to our President Trump, maybe $1 million is nothing. It's like a penny for us, right? So really, that is not a solid definition. But if you go to a steakhouse and your steak costs $2,000 for a meal, you know that's not reasonable. And the normal people eat ribeye steak that costs about $50 to $80 per meal, right? Reasonable people. Maybe you're sitting there goes, Ying, that's not reasonable. A ribeye steak probably should just cost 25 to 35. I don't know. I actually, you know, I actually don't eat out that much because my food allergy. So I have a privilege to eat just at home. So that may be why I'm so disconnected with the price out there, but not to be unreasonable. All right. So food and beverages, and then you or one of your employees must be present when the food and beverage were served. See, we have a privilege as a business owner, and you have to be present. If you're like me, allergic to all kind of things, then I'm sorry, you probably don't use much of a business meal deduction because you're not there. How can you deduct, right? So our next slide tells you for 2022, okay, as a part of the COVID relief, and the government was trying so hard to get the restaurant going. So they give the PPP, they give the RF, they give the ERC, and they give the state, grants. Now they're saying your customer come to eat at your place, we're catering from you. We're going to tell them that they can deduct taxes 100%. So hopefully you, business owner, restaurant owner, you're going to see some uptick of purchase. So that's what the government is doing. 100% deductible. Okay, 100%. And including high-end restaurant and the beverages for business purposes. See, it is always tied with business. You can't be like going, but who is going to the restaurant to eat without a purpose? Of course, if it is your child birthday party, don't deduct out of the business. But if it is you are trying to entertaining all the clients, then you should, right? So that is a business deduction. The food does not need to be consumed in the restaurant. Hear that? Can be catered. Okay. And so I did have the last sentence tell you that the that is ending in 2023. So you don't have to be in a hurry to invite me anymore because it is already ending, and you should have done that in 2021 and 2022, folks. I really appreciate that. A lot of time when people do that, invite me, I tell them my allergy or things, how I'm a little limited with a lot of food, but it's a good opportunity for you to expand your network and with this particular class, okay? But meals for employees, this is something I want to talk about because it is sort of a lot of business owners has this question. So just remember, keep that in mind. So this is like for employee, and that generally speaking, you need to think of that is to be a benefit. And normally a benefit to employee is taxable because you would include that in their paycheck if they did that. And if you didn't do that, and it's only 50% of that is deductible. And of course, if you send employee for travel and you are reimbursing them, that is a business expense. I'm not talking about those ones. I am more talking about the employees are, for example, if you just have this high-end liquor bar in your law office, so when your lawyers got frustrated and you start sending them to the bar, they can drink whatever they want, and those are not necessary business expense. So you should calculate every glasses goblet they take and charge that into their bonus. I'm just saying it need to be taxed. They need to count that as income, and the employer can count that as expense. But if you are saying, oh no, I don't want my employee to do anything, then maybe you cannot deduct that either, right? So just make sure that we are clear. When we give anything on the meal side to the employee, is generally considered benefit to the employee, and the benefit to employee on the meal side is a taxable benefit. And of course, like in, for example, in certain industry, and you have a shift, and the people cannot leave their shift during the day, they have to consume their meals while they're working. And that time when employers supply meals, that is business expense because it is necessary, reasonable for your type of industry. So just keep that in mind. When it's come to employee, it really need to tie your operation very much so, and need to be necessary, reasonable for your business to expense that. If it is not, if it is just you, the business owner, wanting to make it so good for everybody else, that may count into their paycheck as part of their pay. Okay. All right. So now, and what about other business meals and entertainment? You can deduct the cost of meal and entertainment that you sell to the public. What we mean here is that sometimes, businesses has facilities that they can rent it out to people, right? And you rent it out to people, you also come with meals and entertainment to people. Of course, that's your business deduction. And you also can deduct the the meals and entertainment one that is promoting your business goodwill, promoting your brand as a part of the marketing. So when you do that, of course, that's a business expense. I wouldn't put that on the meal and entertainment, because what you do, it is really branding. What you do is really taking yourself out to the public. For example, at Community CPA we have popcorn machines. So popcorn machine, we only use that machine in the community events. So when there is an Asian Heritage Festival or Latino festival, we take our popcorn machine out. Of course, we're gonna buy popcorns, right? So we pop the popcorns, we give it out. And when we give it out in a bag with the Community CPA's logo on it. So with that, we consider as a marketing expense. So we don't really, of course, my staff were eating the popcorns too. And some of them didn't even eat lunch. They just eat the popcorn for lunch. So, but I don't need to add the popcorn cost onto their paycheck saying, hey, you got a benefit, you eat popcorn. It is really expenses overall for marketing, right? So that is deductible. And you can also you can deduct the expenses directly related to and necessary for attending business meetings. So that is more like, for example, in our business, we have this continuing educations that we need to do for staff. And some of those continuing education, you can't find them like within the city we're in. So we have to send them to Washington, D.C., Florida, places like that where the big conference happening. When they go for those places, they of course need to eat. So those are business expenses. And you don't really, normally instead of listing that under meals and entertainment, I would actually group them into the travel expenses and also seminar, webinar training expenses. Just really splitting them up so they are not in the category where it's not necessarily right. But we see a lot of business owners kind of dumping everything onto entertainment. Well, I love you, spirit. You love what you do, so everything is entertaining. But from tax standpoint, you don't want to go that far to make IRS raising the red flag on you, right? So folks, just be very cautious about how you classify your expenses. So our next one is office deductions. This one is rather straightforward because we just want to point out the normal ones, the reasonable, necessary ones. So mortgage interest, insurance, utility, repairs, maintenance, depreciation, rent, and utility again. But this time, the utility is more of the general building related utility. Sometimes you have these certain businesses that the things you use are not normal, and then you can classify them as your necessary utility. But again, and all of the expenses you spend and for your business to run normal, those are reasonable, necessary, and you definitely should do that. Now, I also, in this particular section, we want to talk about home office, right? So that is the office, the CPA firm office, law firm office, manufacturer office, sales office. That's what we were talking about. But what about home office? Home office has two methods. One of them is simplified option. So this one is for you to use on Schedule C and Schedule A. Schedule C, is part of the 1040, and this is how it calculates. Some people goes, oh yeah, I have 1,500. No, you don't automatically have 1,500. Under simplified option, you need to count how many square footage you have. If you only have 100 square footage for your home office, then you only can deduct $500, not 1,500. Right? It is a $5 per square foot of home used for business. And then the maximum is 300. You're a small business. So IRS says that 300 square footage is pretty big, and that is our limit. So they give you the limit, and you have the simplified option, $5 times 300 square footage, you got 1,500 maximum. Okay, on Schedule A, allowed to deduct the full amount of mortgage interest and real estate taxes. And I know that's a lie because President Trump had taken away that whole thing. And remember, don't forget, President Trump lives in Florida, and he doesn't get affected with the changes that he made. And we get affected because we're Midwestern, and we have a branch in California, and all of these states will pay taxes. And in the past, when we come to Schedule A, we can deduct our state taxes we paid for that year, right? So we normally, would come up several $10,000 in there as our itemized deduction, so we can reduce more income on the 1040. But what President Trump did is he gave a total. He goes, no more than 10,000. I don't care about your property tax, don't care about your income tax, and don't care whatever. So you can only do 10,000. So it really doesn't make any sense, because a lot of folks I know, a lot of our clients, even their property tax is over 10,000. So never mind about anything else. And then you just kind of, you pooped right there, okay? So there's not much of a benefit for you. But of course, the standard deduction did get raised a little bit. It didn't help. It didn't really help with people with a very active and successful businesses. So with that said, simplified option, just remember maximum 1,500, and you don't have any other ways to deduct too much about it. And the model 2, okay, it's called the regular model. This one calculates your expenses by percentage of usage. So let's say your house is 1,000 square footage and your office is 200. So you have 20% of business use for your house, right? So now you're going to help me do math. You're going to add your mortgage interest, add your real property tax, add your utility, insurance, and the internet cost, and maybe maintenance and whatever you did to your house. Add all of these expenses. Then you time the 20%. So you would get, in my example, you would have $4,580 home office deduction. Make sense? So this is what we want to talk to you about, the method of home office. All right, next one, depreciation. Trust me, this is a topic we can literally spend whole month on it. And that's how much rules and regulations and specialties there is. But I want to make it really general for you right here. So depreciation is not a real expense, right? I say real expense is like you pay Community CPA to do your tax return, and you really had a damage because you have to pay their money to get that done. But depreciation is not a real money. Depreciation is actually the expense the government allow you to deduct based on the capital expenses that you paid for. For example, if you bought a dental machine, say in dental office, you bought this machine and it cost $250,000. And this $250,000 is called capital expense. They don't land on income statement. No, you can't write it off just like that. Let me show you how to do it. You need to put that on the balance sheet, so become your asset, right? Then you're gonna knock the door of Congress, figure out what tax law they enacted, allow you to deduct as much as possible. So folks know about 179, folks know about bonus depreciation. These are all man-made measures to allow us to deduct capital expenditures. So it is monopoly dollars, not a real dollar, but it goes by tax policies. This is where you hear me saying in the beginning, and the tax people don't want to plan taxes beyond the president's term because these things changes. So right now, with President Biden sitting there right now, the depreciation rules is what it is. So you need to know what you bought and figure out your deduction. So now let's look at my slide I here for you. Okay, so the person who can use the monopoly dollars here are the people who owns the capital asset and must be using it for operation and must have a useful life more than 1 year. If the useful life is not more than 1 year, you should write it off. And for example, tax software, you know how tax software goes, right? You buy them $100 on Best Buy for your TurboTax stuff. Do you buy them every year or you use them multiple years? You buy them every year, right? So that is expense because it didn't have a life expectancy more than 1 year. So they're not capital asset, they are expense. But what is capital asset? Capital asset would be some, for example, in the hospital, you know, when they do ultrasound has software attached to the machine, and that ultrasound machine has life. That software with that ultrasound machine is not the same as tax software, and it has a lifespan more than 1 year. So in that case, what should a hospital do? If they are a profit-making company and they would put that on the capital account, then depreciate that out based on the government policy. Right now, bonus depreciation, and in 2022, you have 100% write-off for that machine. So even though I just said the 250,000 you cannot deduct, it need to be capital asset, but now you apply for bonus depreciation in 2022, then you can deduct the 250,000 in your income statement this year. But it is a tax treatment. It is not a real expense. It's different from cash flow. Am I right? So depreciation, just know that it's a monopoly dollars. It's not a real expense, but it's a good thing to reduce your income. And you want to look at that all the time to see whether you can take advantage of that. All right. What about business bad debt? You know, we covered automobile, we covered business meal, we covered home office, we just talked about depreciation. Now, bad debt. Bad debt, very simple. You have bad debt when you're extended a business loan to your brother-in-law, okay? And he doesn't pay you back anymore. And he's like, sorry, business failed. Don't have money. If you want, this life is yours, no money. That is the business loan go bad. That is your bad debt. That is your deduction. Okay? And the credit sales to customer. Wow, you got this nice customer buying a lot of things from you, always pay you a little bit late, but good customer. Let's not interrupt them. And if they want to buy a gift to them, we know that they're going to pay back. One day come, that customer is gone. And on your receivable, they have $35,000 they didn't pay you. That is your bad debt. Okay, so those are the bad debt that you can deduct. So, but let me also tell you, if you did not have that loan booked on your balance sheet, if that loan is just under the table or you were eating at home in dinner and you wrote a personal check to your brother-in-law and later on you think, well, this can be a business deduction because Ying said, and that is the bad debt. Depends on how you made that deal. That money you give to your brother-in-law should be a check from business to him. You should have a loan agreement with him. And even if you don't have one and you know that you need to go to him and tell him to officially write to you that he cannot pay you. I did borrow that from your company and this is the letter I'm giving you official. You need to have a record. Okay. And it's not encouraged for you to come up with a business loan later. You should have that documentation already, and your accountant already booked your loan receivable from your brother in on your balance sheet. On your balance sheet. That should already be there. Because once that is on your balance sheet, it is part of your asset, right? So when he failed to pay you, you are writing it down and you will reduce your asset and then you will put it on bad debt in your income statement. So what happened to your brother-in-law? Your brother-in-law need to file 1099-C for loan forgiveness. He needs to account that as an income. Then you may say, well, that's not a good idea, Ying. Then my brother-in-law, gonna say that I owe you forever. Then I will never be able to write it down. And now what's gonna happen? No, your brother-in-law needs to report that on his tax return. If he's truly in the stage insolvency, he doesn't need to pay any taxes on that because there is a IRS regulation saying that if your brother's liability is greater than asset, he is officially insolvent. In that case, the 1099-C debt that forgiven is not taxable. So you need to look into that to see whether he qualifies for that. Then you deduct your bad debt. Your brother-in-law would not pay income tax because he is truly insolvent. So with that said, knows that how you deal with business loans and your good customer turn bad, that happens all the time. But one thing you need to remember, and if your customer were buying things from you and you never book that as an income, and then now he doesn't pay you and you lose the cost, you lost your materials per se. So your deduction is limited to the materials because really the bad debt is not really, you didn't really book the income. You are just losing your material. If you book your income, you reverse your income by bad debt. But if you didn't even include that in your income, basically you just had a more cost of goods sold that you used up. So when you account your inventory properly, then that will be absorbed into your expense. So depends on how you book your income. You may not use the bad debt to reduce your income. You may not need to because it is already in your cost of goods sold. With that said, and we are coming to the last slides I have for you, and we're about to wrap up this whole webinar today. And the other ones, I just want to run the train over. Of course, salary, employees pay is deductible. Retirement plan, largely deductible, folks. And the rent expense, interest, taxes, you can deduct all kind of taxes directly attributable to your business as a business expense. Okay, but this is not, we're not talking about income tax, okay, folks? We're talking about excess tax, things like sales tax, things like payroll taxes, right? Those are the taxes it is your business expense. Insurance, you can deduct insurance that keep you safe, the insurance that keep your workers safe, medical insurance, dental, vision, all kind of insurance. So those are the ones you can. And when you have question related to whether this is reasonable, necessary business deduction, you can always rely on the professional. You can talk to the professional. The reason I'm saying you can rely on professional because these people and their profession is to know how to file taxes, how to do financial statement. So they have the data, the tool to search out whether what you are talking about is reasonable or not. So that would give you, once you have that kind of relationship with your service provider, and you can deduct it with a peace of mind, right? Knowing that you're doing the right thing and IRS, even if IRS is going to come back to you and you know that you're not worried because you're doing everything correctly. And I will have to say that in the small business world, right now, people are very relaxed in terms of rules and regulation. I say that to you because we come through the pandemic. So 2020, no audit and a bunch of money thrown away by the government to all kind of people in the business. 2021, the same thing. 2022 just start to recover. We are in the time of 2023. Do you know that IRS hired 87,000 auditors? No, I should not say hired. IRS budgeted for 87,000 new auditors. They have a hard time to fill those positions, but they are expending on audit. They are counting on audit to generate the revenue back to IRS. So that's not, that's not to say that IRS is just, tortures taxpayers. IRS is coming back to put compliance in order. So some of the small businesses, I of course not gonna, here say who and who, but there are business owners believes that if he has never get audited, he will never get audited. The stuff they do is just not right. And we want, I like to live a life where we can sleep without worry. And I want all of my clients to be smart people, know how to save money and be tax efficient, but not doing anything wrong. So that is the whole reason why we're doing education, because sometimes our small business owners were saving taxes in the wrong way. But when we turn them around into the right way doing things, they're saving more taxes. So pathetic. I always tell my folks that, don't think the smart way you have is the way to save taxes. You really want to explore the knowledge. That's the real way to be Americanized in business world. And we are not here to be lucky. You never lucky. And you are small business owners and you don't even speak English properly. And if they don't audit you, who do they audit? Because this type of profiles are inviting audit. So because this type of profiles has a lot of mistakes. So IRS also have data. They know where to go to get those people caught. So it's really, the more the big data works in our life, the more accurate the projection will be. So the IRS is growing their tools. They know exactly which restaurant, which company are not doing the right thing, because they also have data from other people around that business. So with that said, folks, and do all the deduction you can do, and don't give tips to IRS, but at the same time, be a good citizen in business and learn and do business the right way. I want you to know that I have a book on internet, and that is 8 a.m. starting up a business. And I just finished the book, Appointment with Ying at 10 a.m. This is the book to talk about how to grow your business. And once I'm done with the 10 a.m., it will be published in March of this year, which is next month. So I want you to know to look out on Amazon, and it will coming up. And the cover may not be the same. I haven't really figured out how to do the 10 a.m. cover yet, but this cover, it was the 8 a.m. cover, just like you were seeing earlier. See this 8 a.m.? This is the one on Amazon, and this is one coming up, but the cover might be a little different, but it's 10 a.m. So I'm writing 4 business books. 8 a.m., starting up a business. 10 a.m., growing your business. Okay, 2 p.m., scaling your business through acquisition and a merger. And 6 p.m., retiring from your business. A new way of retiring, folks. There is no way you can look at your parents' goals. Oh yeah, that's how I want to retire. Absolutely not. There is no such a thing about we can repeat our parents' path. The history, the technology, the life, the mentality, the mental illness, all of these things in today's world Are you kidding me? If you think you're going to retire like your parent, no. So you need a guidance from me and my other 12,000 clients, how they did their retirement. Not all of my clients are retiring, but a lot of them are. The baby boomers group, they're coming through with businesses either get sold or merged or passed on to their children. So they're retiring. So I use the collective stories to make a point, or at least paint a picture that you know what it looked like when you get to the retirement or when you are ready to scale your business. All right. I will talk to you again next week. I'm so happy to see you are here. Thank you. Bye bye.